What's really good, fam? So I mentioned I'd be getting into a few of my favorite investing books, and today we're going to start with my absolute favorite because it's just super straightforward and simple to understand. We're watching Sekitor, and today we're talking about understanding our place in the market cycle using Howard Marks's book, The Most Important Thing. Now before we continue, I'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism, regardless of the source, and that includes us. So for that reason, anything that we say here should not be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you scroll down a tiny bit, hit the like and subscribe buttons. We'll do our best to help you figure out how to figure out this game for yourself. And with that being said, let's get to it. Alright, so looking into the book, there's one key factor to consider when developing an investing strategy at any point in time. And this factor is particularly relevant to the current moment, and I'm talking about chapter 15, which is having a sense for where we stand. Now before we get into that though, knowing where we stand requires that we understand the framework of a market cycle, which is itself an incredibly complicated model once you get into it, but can be best summarized as this. The market cycle refers to the natural fluctuations of market momentum, leading to market highs or euphoric peaks at those highs, downward adjustments as the peaks start to wane, recessions, also known as market pullbacks, as euphoria dies, and then the troughs or market lows that follow. In this text, when Mark asks where we stand, he's specifically referring to where we stand along this cycle, so let's dig in. Now Marx starts the chapter by saying that market cycles present the investor with a daunting challenge, giving that their ups and downs are inevitable, they will profoundly influence our performance as investors, and they are unpredictable as to the extent and especially timing. Not much more to say about this as it's really straightforward. Ultimately, if we're to value this part of the text at all, we must understand and buy into the observed fact that market cycles themselves are inevitable, and timing the cycles, their depths, and their potential returns is ultimately foolhardy and unproductive. More important to us as investors is what Mark identifies as being the three potential courses of action when facing the market cycle. The first option reads, the first possibility is that rather than accept that cycles are unpredictable, we should redouble our efforts to predict the future, throwing added resources into the battle and betting increasingly on our conclusions. But a great deal of data, and all my experience, tell me that the only thing we can predict about cycles is their inevitability. Now this is a sentiment we get from almost every famous investor, whether it be Marx or Jack Bogle in his discussion on timing the market. There are, of course, those who will pour their resources into identifying where we are in the market based on things like technical analysis and charts, attempting to identify what's going to happen very soon. On Wall Street Bets, this is referred to as posting triangles, and in some circles it's known as astrology for guys who say bet. No matter the case, it's clear that Marx's opinion, and many others, is that it's a waste of time and energy to attempt to perfectly time the future market swings. Next we have the second option, accepting that the future isn't knowable, throwing up our hands, and simply ignoring cycles altogether. This is basically what Bogleheads and Jack Bogle himself would suggest, given that their main strategy is to buy the market and hold it through its ups and downs. Right, like constantly, dollar cost averaging, buying regardless of what's happening, like buying the same amount consistently forever. Given how successful this strategy has been for millions of investors in the long run, I do think this is the best way to go for anybody who doesn't have time to commit to the market or to doing research on stocks and doing all that stuff. Marx doesn't provide any criticisms of this strategy in this chapter or even in his book, Mastering the Market Cycle. Finally, we have the third option, which he calls the right one by a wide margin. Why not simply try to figure out where we stand in terms of each cycle and what that implies for our actions? The rationale for this take: the future is unknowable and therefore generally inactionable. The past is clear but cannot in itself inform us of the present. The present, however, is at worst estimable and can therefore be used as a clear basis for our actions. Specifically, he claims, we must strive to understand the implications of what's going on around us. How do we do this? Well, lucky for us, Marx was kind enough to include what he calls the poor man's guide to the market assessment, and this is at the very back of the chapter. Here we have a left and right column which correspond with certain aspects of the market, so why don't we take a moment and identify where we are using this chart. Alright, let's start with the economy, right at the top. Is it vibrant or sluggish? Well, with record levels of inflation, record low trade deficit, and declining exports, I think it's fair to say that we're far more sluggish than, say, 2 years ago when Korean companies were dominating the EV battery sector, car manufacturing and distribution, and all across the biomed sector from Botox to therapeutics. What about the outlook? I'd say the global economic outlook is generally negative, but it's also exacerbated here due to how trade reliant we are as a nation and how weak the won is getting at current. Also, in addition to all the things I just mentioned, lots of reports have been coming out about how our semiconductor sector is lagging behind places or companies like TSMC, and how our car exports have fallen below China's for the first time ever. I'd say that we're comfortably in a negative space when it comes to outlook. Next, let's talk about credit. How eager or reticent are lenders to give out their money? Well, with mortgage rates at 9-year highs, hitting 3.9% due to key rate hikes and the FSS's efforts to slow down an overheated housing market that started actually at the end of last year, lenders are clearly leaning towards the reticent side of things, though since Moon Jae-in's inauguration, there have been announcements of continued loans to first-time homeowners up to 80%, which I think is like 600 million won. Don't quote me on that, probably look that up, that's best. Next, markets themselves, embattled with issues on foreign money fleeing and retail investors moving into safer assets, are much tighter than they were last year. Throw in the state of the crypto market and the fact that Korean retail investors are thought to have lost a near trillion won in the past year, and it's clear that capital markets for our milieu are in a bad place with low liquidity from both domestic and international investors. Capital is therefore scarce, particularly in the case of high inflation, which progressively devalues the spending power of existing capital. As mentioned before, the terms of loans are much more restrictive now, and although interest rates are historically low, their sudden increases, particularly when contrasted with the rates of the COVID era, are relatively high. Next, credit spreads, when looking at these charts from the last year and 4 years ago, are clearly wide, much wider than they have been recently. Next, we have investor sentiment, which I've talked about at length, so it's fair and easy selection of pessimistic, distressed, and uninterested in buying, as seen by the state of our markets. Similarly, asset owners are selling off in droves, with June being a full month of heavy selling, and if you've been following the housing market outside of the Seoul-gor, you'll have seen similar, albeit less steep adjustments in not only new apartment subscription rates, but also the sales of older apartment units. Markets then lack attention, with billion-dollar company stocks like eMart and H&M sitting at a below 1 PER, which is generally unheard of in normal times. I mean, like, the people are literally valuing these companies less than the amount of money that they're actually making. Like at current, which is wild. Anyway, for that price, I think we can circle low asset prices as well. Now, funds are in an era where I don't feel particularly able to speak on since I don't follow them very closely, but I will say that it's clear that there aren't new funds popping up all over the place like they were during the launch of the K-New Deal and last year's Metaverse Frenzy. Finally, for the sake of time, these are my judgments for the remaining categories. Again, these are personal opinions. Recent performance has been fairly weak for Korea's main industries based around manufacturing and exports. Risk of further losses are neither high nor low, though I personally believe that the majority of economic threats have already been priced into the market. Prospective returns are fairly high, as if the market were to rebound to last year's highs in the future, that would mean a return of 41% for the Kospi, and investors, both individual and institutional, are being cautious, selective, and certainly more disciplined than they were in recent years. And with that, we have a clear visual that can be read thusly, again from the book. If you find that most of your check marks are in the left-hand column, hold on to your wallet. For us, we're almost entirely sitting on the right-hand side of the chart at the moment, suggesting that we do the opposite. Now again, we must remember the early assertion that cycles are unpredictable as to the extent and timing, so while we can easily identify our situation as being at some point in the down cycle, we can't know whether we're here, or here, or here, or here. However, if we believe what we believe to be true, then where our market is at the current place and time is most likely a very good time to be buying low, and that's really the game here, isn't it? Buy low, sell high. Basically, while we can't time the market, we can place more bets when the odds are in our favor. And this is one of the reasons why I'm still buying and why I believe that Howard Marks would suggest that we do the same. Alright, that's it for me. I hope this was really helpful. I'll be back very, very soon to talk actual stocks that I'm investing in with the rationales related to these principles, as well as some of the more tangible aspects of their businesses. I honestly do hope that this was helpful, especially for people who are trying to decide whether or not to get into the market right now, because I mean, if you haven't really even invested anything, that means you haven't lost anything, and this might be not the worst time to get in since we're clearly in the middle of a down cycle. Don't expect immediate returns though, because that's always impossible to predict. Alright, hope y'all doing well. I hope you also have dehumidifiers. If you don't, get those mulmongnan hamas because shit's about to get moldy. Alright fam, take it easy. Peace.